Not too late to max out your solo 401k contributions for 2021. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. On today's episode, if you're self-employed or a small business with no full-time employees other than the owners or their spouses, there is still time to take advantage of generating massive deductions for 2021. So if you have a single member LLC or a Schedule C taxpayer, so if you're a 1099, you have a Schedule C, or you are filing a return for a sole proprietor, single member LLC, you have the ability to still, yes, if you are under extension, still have a chance to claim tax deductions for the 2020 year up until October 15th. Now, if you are an 1120 taxpayer, so if you have an S Corp, for example, or you're a partnership, 1065, you have until September 15th to take advantage of the opportunity to still max out your solo 401k for 2021. So this is probably the only chance that you can still claim some deductions for the 2021 tax year, right? Everything's gone. It's in 2022, right? So you can't have business deductions now for 2021, right? Once January 1 rolls around, you're done. You cannot generate any business related deductions, depreciation, entertainment expenses, food expenses, rent, so on and so forth is gone, right? The year is finished. However, 401k, solo 401ks to be exact, are really the only retirement account other than SEP IRAs where you can still claim deductions in 2022 for the 21 taxable year. For 2021, the most you can contribute to a SEP IRA or a solo 401k is $58,000, or if you're over 50, $64,500. Now, the SEP does not have a catch-up if you're over 50. So before the Secure Act, which was passed in December 2019, only a SEP IRA was able to be created in, for example, 2022 for the 2021 taxable year. Secure Act changed that to allow solo 401k to be established in 2022, so long as it's established before the return has been filed, including extensions, for the 21 taxable year. Now, the only caveat is only profit sharing contributions can be made, not employee deferrals. In 2021, the employee deferrals, if you were under 50, was $19,500 or $26,000 if you're over 50. Employee deferrals are dollar for dollar, meaning if you made $30,000, you can contribute $19,500 or $26,000 if you're over 50. Profit sharing is a little different. It's essentially a percentage. Profit sharing is also known as employer contributions. It's essentially 20% of your comp if you're a single member LLC or a sole proprietor, and 25% of your W-2 if you're a CRS. Now, don't ask me why the percentages are different. It's a complex calculation, but trust me, those are the numbers. So if you made $100,000 and you're a sole proprietor, you can put away 20%. If you just had a pure profit sharing plan, like a SEP, that's $20,000. Or if you had a W-2 S Corp, you could do 25%, $25,000 of $100,000. So as of today, 2022, so long as you adopt a plan either before September 15th, if you are an S Corp or you follow 1065 partnership, or October 15th, if you follow 1040 Schedule C or an 1120 C Corporation, you can establish a plan, whether it's a SEP or a solo 401k plan, in 2022 for the 2021 taxable year. That means you can potentially gain deductions of up to $58,000 if you're under 50 and $64,500 if you're over 50. So let's say you made 200K, okay, and you're listening to this podcast, you're watching this podcast, and you haven't set up a SEP yet or a solo 401k. Let's assume you're self-employed you're a consultant, you get paid on 1099, okay, or you have a single member LC, and you make 200K net, Schedule C, you can do 20% of 200K, it's $40,000 deduction. Meaning instead of paying tax on 160, on 200, excuse me, you're paying tax on 160. Plus that $40,000 now is in a retirement plan that can grow without tax. Now in 2022, you can start adding employee deferrals. But for the 21 taxable year, you're relegated to just doing profit sharing. Not ideal, but hey, $40,000 deduction is a massive deduction that you can get in 2022 for 21. It's really the only available deduction that's still left, right? If you're scrambling to reduce your taxable income, if you're an accountant, you're listening or watching this, or you're just interested, you may want to reach out to your tax professional and let them know if you do not have a retirement plan set up, either to SEP or a solo K, you should set one up. I strongly suggest doing the solo K, and I'll explain why. I've written 2 books on the solo 401K. The SEP IRA is a pure profit sharing plan, right? It's 20% of your Schedule C or 25% if you're a W-2. Okay, the aggregate is 58K or 64.5 in 21. In 22, it's a higher number of 61,000 or 67,500 if you're over 50. Now, a solo 401k has the employee deferral of that 19,500 or 26,000 in 21, plus that 20 or 25%. Okay, so if you made 100K and you had a SEP IRA, let's say you're an S Corp, only owner, only employee, you can do 25,000 bucks, 25% of your 100K W-2. If you had a solo K, you can do 25K profit sharing, same as a SEP, plus the, let's say 21 in 2021, the 19,500 or 26,000 if you're over 50, plus that 25, right? So if you're over 50 W-2 S Corp in 2021, making 100K, you can do a max of $51,000, whereas a SEP is only going to give you the 25,000. Okay, so that's obviously a monster deduction. Now, if you're sitting in a position today where you still haven't filed your return, you're on extension, you either don't have a SEP or don't have a solo, you should strongly move in the solo 401k direction, because yes, for now, for 21's purposes, the SEP and the solo is the same. It's only a profit sharing plan. That's all you're going to be able to do. But going forward, once you've made your 21 contributions, you can start taking advantage of contributions for 22 and get that employee deferral, get the profit sharing. Also, the solo 401k has a loan feature that lets you borrow $50,000 or 50% of your account value, whatever's less, and use that loan proceeds for any purpose. It's a 5-year loan that you can pay back at least quarterly. Lowest interest rate currently as of September 2022 is 5.5%. But the good news is you're paying yourself back. So you get tax-free, penalty-free for the money, and you're paying yourself back at 5.5%, which is a pretty good rate of return. Okay. Plus, if you're a real estate investor, there's a great exemption on the unrelated business taxable income for 401ks, where you can use non-recourse leverage to acquire real estate without paying this 37% UBIT tax, which applies to SEP IRAs. Very easy administration of solo K. Under $250,000, you have 0 IRS reporting requirements. Over 250, to follow 5500 EZ, which if you're a client of IRA Financial will help you do it. It's literally 1 page, takes no longer than 5 to 7 minutes. So all in all, the solo K will beat the SEP IRA in any which way. So if you are looking to set up a plan in 2022 for the 21 year, take advantage of up to 58,000 or 64,500 deductions still available, I would just set up the solo. The Secure Act 1.0 allows us to do that. So take advantage of it. There is a potential that for next year, Secure Act 2.0 could be passed by the end of the year and signed into law by President Biden. And potentially there's rumors that Secure Act 2.0 will, in the final iteration of the bill, have a provision that will allow for employee deferrals to be made for a former year and a current year. So if Secure Act 2.0 was passed now or last year, for example, you'd still be able to do employee deferrals for 21 in 2022, so long as you haven't filed your extension or haven't filed your return for the 21 taxable year. So everything would be open. However, the law right now is just employer contributions, just the 20 or 25%, but you can climb as high as 58 or 64,500 if you're over 50. Of course, you're going to need income, right? If you made 100K, all you can be able to do is the 20 or 25K if you're a W-2, 20K if you're a sole proprietor. If you made $1 million, clearly 25% or 20% of $1 million is 200. You're capped out at the 58 or 64.5, so you'll reach your maximum deduction and be able to reduce your taxable income. So hopefully I caught you in time. I mean, this is the last massive deduction that's still available. That's it. SEP IRA or solo 401k. Everything else is gone. Okay. Everything else had to be done by 12/31/21. So you have time. Okay. You can set up the plan. It takes a couple days to set up the plan. Again, I would do the solo over the SEP. As long as that check is dated before September 15th or October 15th, you're good. You get the contribution, you get the deduction. That money's now in the plan. It can grow without tax. It's in a solo. You can borrow against it, 50,000 or 50% of your account value, whatever's less. You can roll other retirement funds, pre-tax IRAs, 401ks into it, and then use that not only as a great retirement vehicle, but also as an investment vehicle to do traditional investments like stocks, but also alternative assets like real estate or precious metals or cryptos or private business investments. So it's a really robust and super powerful retirement plan that you can still take advantage of for the 21 taxable year. So why do you want deductions? Well, deductions reduce taxable income, less money to Uncle Sam, more money in your pocket. Best of all, it's in a retirement plan, so it will grow without tax by taking advantage of the power of deferral. If you need a little bit of cash, you can always do a loan. SEP IRAs have no loan. SEP IRAs have no Roth options. Solo K have Roth options, loan features, plus that employee deferral for 2022 and beyond, which the SEP doesn't have. So again, Solo K beats the SEP IRA every which way, and it's not too late to set one up for 2021 and get yourself massive, monstrous deductions that could really have a super huge impact on your tax position and hopefully save you a lot of tax. So accountants, CPAs, tax professionals, if you're listening, reach out to your clients that don't have retirement plans set up that are self-employed. Trust me. One tax professional or another, go solo. You're going to get way more options than just a regular old SEP. If they have set one up, great. Make sure they're making contributions. They can still do it for 21 in the 22 taxable year. A lot of people kind of don't realize the Secure Act 1.0 was passed. It came into law for 2020. We all know what happened in 2020, COVID, everything kind of went upside down. But time to focus on this, considering that these potential for 58 or 64,500 in deductions are still available and still could have a meaningful impact on your clients or your tax return and tax liability. So hope this helped. Appreciate you guys spending some time here today. I hope I've saved some people some money. Rather the money go to you than Uncle Sam. Trust me, I love America, but it's our money. Let's hold on to as much as we can legally. And again, these deductions are legal deductions. It's a retirement plan. If you have a retirement plan from IRA Financial, you will get an opinion letter. So you know the plan has been pre-approved. Nothing to worry about. Your accountant can help you calculate your deductions, or we can. We have experts. I've written 2 books on this stuff. So trust me, my team is super trained. And we literally wrote the book on the Solo K. So if you haven't set up a plan, you're self-employed, small business owner, you don't need a Google business. You can be a consultant, a math tutor, even Santa Claus. And as long as you make a little bit of income, you can potentially contribute up to your income and up to the 58 or 64.5, reduce your taxable liability and put the money in your pocket instead of the government. So thanks again for spending some time with me today. Super appreciate it. Hope you guys enjoyed the podcast and definitely check it out again next week. Take care and have a great day.